Yo, alright, we up on stream. What's going on? Where we leave off last week? Oh yeah, we was looking at stocks and stuff. After that conversation I had with that friend of mine, it's a bit of a later stream today. I'm usually on before damn near 10 minutes to 10 o'clock. But, it is what it is. Alright, so there's a few things going on in the market this morning. One of those things is like I'm hearing word that, or not just hearing word, but I've been hearing word for a while that, they're about to do like a 24-hour market by combining stocks or tokenizing stocks. So just like the crypto game is a 24-hour market, you can always get into crypto, trade all hours of the day and night. From what I'm understanding, they're about to do the same thing they're about to tokenize stocks and do the same thing with them, right? And I'm saying that because we're still looking for, y'all probably think I got a wig on it. I just feel like this out of my head. Like I come on here and like I've always felt like this side of my head is just like a little bit higher than this side. Don't look at it though. Thank you. Anyways, but yeah, they're planning on tokenizing stocks. And because of that, I'm not gonna say I don't know what to be looking at right now. We're just staying informed. We're investing in ourselves per usual, We're edifying ourselves. What I've been doing recently is I've been I was reading something. But what I've been doing recently is I've been meme coin trading. I've been looking at meme coin trading a lot. I'm up in one of my coins right now, 18%. And I'm not too much getting into like too much extra stuff. Like I'm waiting for the market to correct it, so we can look at the charts actually. That's what we'll do. This Bitcoin right now. This is the daily chart. It's holding, it's holding that same position that it was holding before. It's funny because my buddy Rico, he was trying to tell me that like this was finna explode or something was happening. Actually, let me not say that he was saying that, because then I called him and he said he was saying something completely different. So it just is what it is. How I just feel is, this is just what I feel about this whole Bitcoin pump that happened like the other week is I really just feel like the same thing that happened when that last bull run with crypto happened. Everybody ran to crypto in order to make some money, not realizing that, it's kind of like a tsunami, right? Think about this investment game like a tsunami, especially when it comes to the crypto and the stock market. When you see the water running away from you, they say, okay, so they usually tend to say, when you see the water running away from you, run away, run the opposite direction. But in this crypto stock game, when you usually see that water running away from you, so it's receding, like further and further out towards the ocean. So like, let's say you're standing on the beach and this is the ocean, and it's usually right there, touching your toes and everything. If you see it start running away, that usually means like a big wave is about to come. Usually a tsunami, right? So you could think of the stock market and the crypto market like that. When the water starts heading over towards the stock market, that means that the crypto space is starting to get a little bit dried up, right? This crypto space is going on a bear run and everything like that. It's going down, whatever you want to call it. But then the moment that those tides come back in, the city's finna get hit with a tsunami of liquidity. That's good right there. I like that analogy. The city is finna get hit with a wave of liquidity. So if that city that was behind you was the crypto market, whoosh. But guess what? Tsunamis don't last forever, right? So just as that water came in, that liquidity came in and washed over that city, you know, money started going down in the stock market. You know, people, we start seeing days like this. Hold on, I thought this shit would be done loaded by the time I'm done talking, but apparently not. You start seeing like this, where all we did last week was bet on uptrends, bullish trends, how we ended up blowing the account. That's not the only way we ended up blowing the account, but the account's blown. It is what it is. We move on. We can always buy another one once we see corrections in the market. But, you know, I'm just deleting shit right now so you guys can get a better view. This blue thing is fucking with me. Bro, I'm literally clicking on it. Move. Y'all probably just like, we don't care. Move on, come on. We get it. This my OCD. I don't like things beating me. My OCD's gonna fuck with me. This one. Carter, you about to get in trouble? Are you somewhere you know you're not supposed to be? Thank you. There you go. Okay. Alright. Carter, are you about to get in trouble? Are you somewhere you know you're not supposed to be? Thank you. Stop going over there. Go lay down over there. Talking to my dog. Like, this nigga's smart. He's just like a child. He gonna keep testing that damn, pushing that damn barrier, testing the line and shit. Yeah, play with your little bottle. But yeah, you start seeing markets like these. Tide started receding. You know, tide started receding, going the opposite way. I say around here, and also like a few months back. And then as soon as the waters came back, and this stuff started happening, people ran to Bitcoin. People ran to Bitcoin as soon as that started happening. You see that? Boom. So you see the uptrend, boom. After you see the uptrend, it's easy to catch the downtrend, boom. You see all of that, boom. I'm not even saying all of this was exactly what was happening over there, but like, boom, you see all of this downward motion. After you see all of that downward motion on the S&P, boom, you see that? Oh, what happened? I was just in Sam's Club. Yeah, I'm a responsible adult. I get my items in bulk, just like mine. Yeah, I was about to make the reference, but I literally cannot remember. Honey Bunches of Oats, just like I like my Honey Bunches of Oats. If you fuck with Honey Bunches of Oats, let me know. Oh, yeah, okay. Mm. So that's what the charts are looking like today on her. Let's see what I usually chart the 30-minute orb. 30-minute ORB. If y'all remember the other week, the damn heat maps wasn't working. I don't know why they weren't working. Kill zones. Okay. Uh, maps. Everything's green right now. Or it's looking heavily green. But what is the market doing? Just to tell you everything you need to know, my boy. Just to tell you everything you need to know. Because in a healthy market, all of that green would mean that the market is moving up, but it don't look like that right now. I'm not even saying I'm the best trader in the world. Never said that. Never claimed to be. It's just, certain things tend to happen. Like I've been in this trading space. I've been watching candles for like a good 5-6 years. A good 5 to 6 years. I've been, you know, studying candlesticks and charts and patterns for at least 5 to 6 years. I options traded before, I futures traded. But if you see here, look what zones is playing around in. Y'all see it? There was a point in time where you could expect like a big move at least by like 9:45. They always told you wait till like 9:30 to get into a trade. By 9:45, liquidity was in. All the real investors were in. That shit was running. So that's another thing. If you're seeing people on social media, talking about they making all of this money, they making all of this bread, all of this cheese, or whatever, LARPers. Trying to tell you, LARPers. Damn near 90%. Damn near 90%. I'd even say a little bit higher than that. For real, I'd even say a little bit higher than that. I'm in this shit every single day. Even when I'm not like actively trading, I'm at least looking at the charts. So like, whoever you see who's online, who's talking about, hey, I made all of this cheese off trading. I'm not saying that they didn't. I'm just saying they didn't do it in this market. They didn't do it this week. They didn't do it last week. They didn't do it the week before. I'm just being honest. They probably already been trading for a while. They probably already been investing in other things for a while. They probably are currently investing in other things for a while. Shit. 9 times out of 10, a lot of them, what a lot of these investors are doing is they're making the majority of their money off you guys. I don't think y'all understand that. They're making a lot of the money off you guys in a way of either they're selling courses. I'm pretty sure y'all know that. They're selling courses and y'all paying for them with simple information that you can get off YouTube University. Everything I know, I had to learn off of YouTube. I've never paid for one course. Never paid for one course. Personally, myself, I've had courses before. I done found them online through little sketchy websites and all different type of shit. That's always been my niche. Finding ends to things. You nasty bitch. My dog just farted. But I'll probably finish start smelling it here in a minute. Oh my gosh, these parts stink so bad. But yeah. They're selling you courses. They're making money off of social media platforms in general, like just by posting and being a big name on the platform. They're making money probably doing what it is that they're trying to teach to do. So they're probably making like a little money here and there off of it. They're 9 times out of 10 investing into other areas and other things. Like there's lots of like they'll get online and subscribe to a certain niche, something that they know that they can show proof of like income from, and just like, ooh, I got to pay out, ooh. But if you think about it, right? If you're thinking about turning, right, trading into a job essentially, right? Okay, you pay the $100 or whatever for the futures account. You trade on the account. You lose that account. That's 100. Lose that account, 200. Lose another account, 300. Lose another account, 400. Lose another account, 500. I'm telling you exactly how this should be going. Like literally, people pay their dues in these markets, right? Let's say on your 6th account, you get a payout. Let's say the payout is 2,000, right? You make your money back plus some, right? My fault. I had to text somebody back. But yeah, you make your money back plus some, right? But then you also got to pay yourself back. You put 600 into it. So really, out of that 2,000 that you made on that payout, you really made 1,400. All right. Then you go and you buy another account. You scale up. Now let's say this war is continuously going on. They're still talking about different things, whatever. It's very so likely and possible that while all of this stuff is going on, you lose that whole 1,400 trying to get yourself another payout. Now, I'm not saying that this stuff is like guaranteed to happen, like, oh, you're never going to be profitable, but profitable is really just a mind state, a mindset. Profitable, being a profitable trader literally just means that you can understand and call when a good market is going on. I really bought this account before, like for this 10-day challenge, as a challenge for myself to see if I can make money in any kind of market condition. Because I was already planning on holding off type shit. I know. Oh, you could say that because you lost the account now. Yeah, I probably would have been popping my shit if I beat the account. But I want to suggest anybody trade in these kinds of market conditions. Carter, get your ass back over here. Lay down. But yeah. Profitability is literally just a mindset. Because there's no reason why the market should look as green as this, but not be doing shit. Like, even if, right, you did the 15-minute order, only charting the first 15-minute candle, right? Which is this candle right here. Even if you charted this level right here. I gotta get it right, guys. Boom. Started that right there. You're really not up that much bankroll. Plus, on top of that, you got stopped out. How many times? Okay, you probably got put, if you were expecting the market to go down and you set your levels properly, you got stopped out 1, 2, 3, 4 times. Just like there's 4, at least that I see, 4 fake outs, or what I would call a fake out, before even heading in this direction. And then on top of that, you're not even up crazy cheese. You're not up that much money right here. I wish I had. I wish I had a damn account to show you like how much cheese you be up or down, but like you're not up that much money.
Now we're going to have some fun on America's Game of the Week on a cold day at Lambeau Field. We get ready for the Los Angeles Rams. Now we're going to have some fun on America's Game of the Week on a cold.
But yeah, that's essentially what this market is. What I've personally been doing is I've been over here. I've been over here looking at meme coins. Now, when I make some like substantial money on here, I'll probably put y'all on. I'll probably put y'all on when I make some substantial money over here. Don't look at this over here or anything. Like, I got multiple different accounts. But, yeah. So what we'll be doing is we'll inform ourselves. What's the guy he said to look on? Ticker symbol U. Why'd that pop up? I feel like motherfuckers is listening to me. Of course, like I'm on stream, but like, don't do that shit. Don't listen to me like that. Okay. What he got right now that's popular. Popular 3 years ago. The AI war has begun. Every Google I/O AI announcement supercut 3 years ago. Looking for some more recent. Let's watch, I guess, his latest video, and then we'll start watching his more popular
The
ones.
single biggest argument against AI stocks just
Damn, can't even do that. Hold on. We gotta watch it like this, and then I gotta edit it in later.
died. Wall Street analysts have been saying the same thing for years now. AI is a bubble, and the entire tech sector will crash as soon as spending slows down even a little. But three major developments just put an end to that argument and kicked off what could be the next phase of the AI era. My name is Alex, and I spent 8 years as an electrical engineer and AI researcher at MIT. And I've never seen chip companies move this fast. Let me show you what's going on and how I'm investing in it. Your time is valuable, so let's get right into it. The biggest case against AI has always been that spending will eventually slow down, and when it does, every stock that lives and dies by that spending will go down with it. It's only a matter of time. Hyperscalers like Google, Amazon, Microsoft, and Meta platforms report their capex budgets every quarter, and every quarter it's been growing like crazy. In fact, their AI spending has been compounding at over 60% per year since 2023, and it's actually expected to speed up. These four companies are currently on course to spend over $700 billion on data centers this year alone, compared to the $375 billion they spent in 2025. That's a 90% increase year over year, and it's coming at a huge cost. Amazon's free cash flow went from $18 billion to negative $7.6 billion over the last 12 months. But just a few weeks ago, Amazon increased their capex budget for 2026 from $200 billion to $220 billion due to the price of memory chips. That same week, Alphabet added $15 billion to its capex budget while reporting that their free cash flow turned negative for the first time since Google went public in 2004. And Meta's free cash flows are down by 91%. You'd think that spending would slow down once the biggest companies driving it burn through all their cash flows, and then some. But instead, they're borrowing money and issuing new shares. Amazon sold $37 billion worth of bonds in quarter one. Alphabet issued over $65 billion worth of bonds so far this year and announced an $85 billion equity raise in June, the biggest raise in American corporate history. Debt covered 9% of hyperscaler capex in 2024. Today, it covers 32%. It's important for investors to understand why spending isn't slowing down and why these companies keep investing in AI at all costs. Data center infrastructure is a zero-sum game. There's only so much land and grid-connected power in the first place, and every acre and gigawatt you don't get is one that your competition does. A big new data center can wait anywhere from 2 to 6 years for a grid connection. And even when it's all bought up, spending will just shift to the next big bottleneck. Cooling, compute density, network and memory speeds, all of which are zero-sum games too, since every single part of the AI stack is currently supply constrained. So the question isn't whether AI spending will slow down, but where it will shift to next. And three of the biggest AI chip companies on Earth, Nvidia, Cerebras, and AMD, all have very different answers. Let's start with AMD. AMD's answer is memory. An AI model is made up of billions of numbers called parameters, and the actual value of each parameter comes from the patterns that it learned during training. Those values are called weights, and each weight takes up about 16 bits, or 2 bytes. Debt covered 9% of hyperscaler capex in 2024. Today, it covers 32%. It's important for investors to understand why spending isn't slowing down and why these companies keep investing in AI at all costs. Data center infrastructure is a zero-sum game. There's only so much land and grid-connected power in the first place, and every acre and gigawatt you don't get is one that your competition does. A big new data center can wait anywhere from 2 to 6 years for a grid connection. And even when it's all bought up, spending will just shift to the next big bottleneck. Cooling, compute density, network and memory speeds, all of which are zero-sum games too, since every single part of the AI stack is currently supply constrained. So the question isn't whether AI spending will slow down, but where it will shift to next. And three of the biggest AI chip companies on Earth, Nvidia, Cerebras, and AMD, all have very different answers. Let's start with AMD. AMD's answer is memory. An AI model is made up of billions of numbers called parameters, and the actual value of each parameter comes from the patterns that it learned during training. Those values are called weights, and each weight takes up about 16 bits, or 2 bytes, of memory. So, a model with 400 billion parameters needs around 800 gigabytes of memory. A single NVIDIA H200 GPU has 141 gigabytes of memory, so you'd need about 6 of them just to ask the model a single question. Today, those weights live in memory that sit outside of the processor, and the processor spends most of its time waiting for data to arrive. That wait time is the bottleneck. On August 6th, AMD announced plans to acquire a company that fixes this by etching the model directly into the chip. The company is called Tolerance from the patterns that it learned during training. Those values are called weights, and each weight takes up about 16 bits, or 2 bytes, of memory. So, a model with 400 billion parameters needs around 800 gigabytes of memory. A single NVIDIA H200 GPU has 141 gigabytes of memory, so you'd need about 6 of them just to ask the model a single question. Today, those weights live in memory that sit outside of the processor, and the processor spends most of its time waiting for data to arrive. That wait time is the bottleneck. On August 6th, AMD announced plans to acquire a company that fixes this by etching the model directly into the chip. The company is called Thales, a chip startup founded in 2023, and it etches AI model weights directly into the metal layers of a chip so they don't have to be loaded from memory. The benefits here are huge. Total throughput, all have very different answers. Let's start with AMD. AMD's answer is big new data center can wait anywhere from 2 to 6 years for a grid connection. And even when it's all bought up, spending will just shift to the next big bottleneck. Cooling, compute density, network and memory speeds, all of which are zero-sum games too, since every single part of the AI stack is currently supply constrained. So the question isn't whether AI spending will slow down, but where it will shift to next. And 3 of the biggest AI chip companies on Earth, NVIDIA, Cerebras, and AMD, all have very different answers. Let's start with AMD. AMD's answer is memory. An AI model is made up of billions of numbers called parameters, and the actual value of each parameter comes from the patterns that it learned during training. Those values are called weights, and each weight takes up about 16 bits, or 2 bytes, of memory. So, a model with 400 billion parameters needs around 800 gigabytes of memory. A single NVIDIA H200 GPU has 141 gigabytes of memory, so you'd need about 6 of them just to ask the model a single question. Today, those weights live in memory that sit outside of the processor, and the processor spends most of its time waiting for data to arrive. That wait time is the bottleneck. On August 6th, AMD announced plans to acquire a company that fixes this by etching the model directly into the chip. The company is called Thales, a chip startup founded in 2023, and it etches AI model weights directly into the metal layers of a chip so they don't have to be loaded from memory. The benefits here are huge. Total throughput goes way up and latency goes way down when the processor stops having to wait for data to come from memory. But the trade-off is pretty huge too. Each chip is permanently dedicated to a single specific AI model, exchanging general-purpose programmability for maximum efficiency. If the acquisition does go through, AMD will combine these specialized chips with their own Instinct GPUs and rack-scale setups like Helios so that the GPUs can process prompts and manage dynamic workloads, while these new fixed-weight chips handle the memory-heavy decode phase of inference, kind of like NVIDIA's recent partnership with Grok. But where Grok's language processing units, or LPUs, have 500 megabytes of ultra-fast on-chip memory, Thales's HC1 chips turn the model directly into hardware. A weight of 1 is a physically connected wire, and a 0 is a broken path, so the math is automatically executed as data simply flows through the chip without any traditional instruction cycles. And speaking of data, I started getting way more spam phone calls and texts right around the end of the pandemic. And when I asked my friends, they said the same thing. So I decided to dig into it and found that hundreds of online data brokers were collecting and selling my personal information, and they might be selling yours too. That's when I joined Delete Me, the sponsor of this video, and I've been with them ever since. Delete Me is a hands-free subscription service that will remove your personal information from those online data brokers. My server websites care about your families. With my code, symbol link in the brief of moving data, Talus's chip completely destroys channel and keeping my family's data safe. Alright, so Talus's chip completely destroys the memory wall, which is the big bottleneck of moving data back and forth between a processor and separate memory. Here's what that means in practice. A typical cloud AI provider can serve a model like Llama 3.18b at around 140 tokens per second per user. That same model can hit 17,000 tokens per second on the Talus chip, making it around 120 times faster than a traditional GPU. Responses are generated so fast that entire pages of text appear instantly rather than streaming in line by line. But here's the big problem. If the chip is directly tied to a single model, and chips take years to design, doesn't that mean that the chip will be obsolete by the time it leaves the production line? Well, actually, Talus found a way to get around that problem with a pretty clever design. Instead of redesigning the whole chip for every new model, Talus uses a tiered manufacturing process that breaks the chip into more than 100 physical layers of silicon and metal stacked on top of each other. Everything underneath the top two layers, the transistors, the power distribution, the math units, and the memory, never has to change. Only the two metal layers at the very top translate a model's specific weights into a physical chip. And since 98% of the chip stays the same between models, they can be.
Alright, so I'll pause the video after running it back like 15 times. You know, a lot of y'all don't take the time to actually like, you know, understand the information being given to you. I want to understand this information. So if I gotta pause and rewind the video multiple times, I will. I don't give a damn. I'm on stream. I can edit this in. I can do YouTube magic. But I stopped the video this time because I want to go and grab a pen so I can take notes on what's going on. So I'll be right back.
Be made ahead of time and stored until a model is chosen for that chip. Then, once the two layers are designed specifically for a new model, TSMC can pull the base wafer off a shelf, add those two layers, and ship the chip within 60 days. This 2-month turnaround completely shifts the economics around data centers. Instead of buying general-purpose GPUs or spending many years and many more billions of dollars designing custom ASICs, they can just buy a cluster of chips hardwired for specific models, run those chips for a year, and then literally swap them out when the next model drops. And not only is it up to 120 times faster than a traditional GPU, it's also roughly 20 times cheaper, since it's made on older 6nm technology. It has no high bandwidth memory, and it uses much simpler chip packaging. Thales also says that their chips cost less than a penny per million tokens to run, versus about 3.8 cents for an NVIDIA Blackwell running the same model. So when spending shifts from acquiring land, buildings, and power, AMD is betting that it'll shift into hyper-optimized low-cost chips that can be easily swapped out as models keep improving. But while AMD is cutting costs, Cerebras is cutting cables. A modern AI cluster has thousands of separate chips stitched together with network cables and switches. Every time data moves from one chip to another, it costs time and power. And just like with memory, chips can spend more time waiting for the data to arrive over a network than they spend processing it. Think about what this actually means. Chip makers spend tens of thousands of dollars turning a big silicon wafer into dozens of individual chips. Then they spend billions of dollars connecting those chips back together inside data centers. Cerebras is betting their entire company that this approach is wrong, so they never cut the wafer in the first place. Instead, they turn it into one massive chip called the Wafer Scale Engine, or WSE for short. Their current generation is the WSE3, and each side is about 8 inches. That's around 30 times more area than NVIDIA's Blackwell B200 chips. If NVIDIA's chips are the size of postage stamps, then Cerebras's are the size of dinner plates. But as you know, size doesn't matter. It's all about how you use it. Cerebras's chips have 4 trillion transistors. That's 19 times more than NVIDIA's B200s. But since the chip is around 30 times bigger, that means that NVIDIA actually packs over 50% more transistors into the same area, because their chips are made on a more advanced process node by TSMC. The wafer scale engine also has a whopping 900,000 cores, 4 times more than Blackwell, and also comes with a whopping 44 gigabytes of SRAM, which is the same kind of high-speed memory used in the Grok LPUs, except, 88 times more of it. That memory can move data at 21 petabytes per second, which is about 2,600 times the memory bandwidth of NVIDIA's Blackwell B200s. There are over 18,000 titles on Netflix, and their uncompressed master archive is about 4 petabytes. That means this Cerebras chip can move Netflix's entire library between cores 5 times every second. That's a huge deal for AI inference performance, and it's all because NVIDIA has to move their data between chips, across cables, and through switches, all of which add extra time to every transfer, while Cerebras simply moves data across one massive chip. No hops, no cables, only compute. Cerebras just reported earnings for the first time since going public, and the numbers speak for themselves. The remaining performance obligations hit $25.4 billion. That's basically their backlog. Cerebras is guiding for $880 to $890 million in revenue this year, so that backlog is worth about 29 times everything they expect to sell in 2026. They expect to deliver on about 22% of that backlog in the next 2 years, and another 43% in the 2 years after that. That first chunk works out to about $5.6 billion by the middle of 2028, or roughly $2.8 billion per year, which means their revenue should roughly triple. Revenue from hardware came in at $82 million, which is up 17% from last year. On the official books, hardware sales look like they fell by 23%, but that's only because of a $28 million charge for stock warrants that Cerebras handed to OpenAI. If you remove that charge, their hardware sales grew. This is exactly why I ignore headlines and dig into the numbers myself. Alright, hardware sales are up, but only by 17%. On the other hand, revenues from cloud and services hit $127 million, which is up 287% year over year. So the real money for Cerebras is in selling access to their machines, not selling the machines themselves. And their gross margins fell, but mostly because they can't build capacity fast enough to serve all of the demand for their chips, so they actually end up renting their own systems back from the cloud companies that bought them to fill the gap. So while AMD and Thales are betting on model-specific chips, Cerebras is betting on wafer-sized ones. But we can't talk about the future of AI chips without talking about NVIDIA. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That really helps, and it lets me know to make more content like this. Thanks. Now let's talk about Nvidia. The question isn't whether AI spending will slow down, it's where it will shift to next. Nvidia's answer is to the chips themselves, as investable assets. Think about how you'd build a skyscraper. Nobody is paying cash. A developer borrows most of the money because the building holds its value, and the lender knows that it can be sold if something goes sideways. That's all an investable asset is, something you can borrow against because everyone agrees it'll still be worth something later. AI data centers mostly get paid for out of a company's free cash flows, which, as I just said earlier, is starting to run out. So Nvidia is trying to change where that money comes from altogether. On August 10th, Nvidia announced deals with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to build financing platforms for over $500 billion worth of AI infrastructure. None of that money is Nvidia's. It's pension funds, sovereign wealth funds, insurers, the slowest and most conservative money on the planet. Jensen Huang's big idea is that a GPU makes good collateral because someone else will always want it, and Nvidia's software updates extend its useful lifespan over time. For example, Nvidia came out with an open source software package called TensorRT LLM, which doubled the inference performance of large language models running on H100s. That means every H100 already sitting in a data center got roughly twice as good at running large language models overnight for free. And that software also works on NVIDIA's older Ampere and Ada Lovelace chips too, and all the way up through Blackwell. The part that I'm not so sure about is what these older chips will actually sell for on the second-hand market. Cars lose a lot of value based on their age and how they compare to newer models, not just on how fast they drive or their miles per gallon. AI chips might depreciate the same way. We just don't know yet. There are also three big catches to NVIDIA's deals. First, none of them are binding, at least not yet. Nobody has actually committed a single dollar. Second, NVIDIA could quietly be on the hook for the difference. An NVIDIA blog post published the next day said that NVIDIA may cover up to 25% of the losses if the equipment ends up being worth less than a loan assumed. And third, the loans can last longer than the contracts to pay them off. The same day as the announcement, CoreWeave closed a $2.6 billion loan against its GPUs. The loan runs for about 5 years, while the customer contracts renting those same GPUs only last for 3. So if those GPUs don't get rented again 3 years from now, even though they'll be much older, that could cause some serious issues with paying back the 5-year loan. So the big question the market needs to answer is, what is the actual useful lifespan of a GPU? Is it 3 years? Is it 5? That determines whether they're worth investing in as an asset class at all. And we might get an answer on August 26th, when Nvidia reports their earnings. Either way, the biggest case against AI has always been that spending will eventually slow down, and when it does, every stock that lives or dies by that spending will go down with it. But Amazon and Google both went free cash flow negative and raised capital to spend even more. So the question isn't whether AI spending will slow down, but where it shifts to next. And three of the biggest AI chip companies all have different answers. AMD is betting it'll shift to hyper-optimized low-cost chips. But where it shifts to next. And three of the biggest other AI spending will slow down, but where it shifts shifts to next. And three of the biggest AI chip companies all have different answers. AMD is betting it'll shift to hyper-optimized low-cost chips that can easily be swapped out as models keep improving. Hyper-optimized low-cost chips that can easily be swapped out as models keep improving. Cerebras is betting on wafer-sized chips that cut out rack-level network models keep improving. Cerebras is betting on wafer-sized chips that cut out rack level network cables and switches altogether. And NVIDIA is betting that GPUs will turn into an asset class of their own. because somebody will always want to rent them. Either way, I expect AI spending to keep speeding up until the world runs out of land and power for data centers, and after that, spending will just shift to filling them. Money is no longer the constraint here. That's why I think investing in AI is still a great way to get rich without getting lucky. And if you want to see even more stocks I'm buying to get rich without getting lucky, check out this video next.
All right. So, uh, he wrapped up the video, and for his video, what he said was AI spending likely. So, the gist of the entire video was AI spending likely won't slow down. Um, and because, you know, everywhere they're talking about the AI bubble will pop at some point, and by pop, they mean like essentially AI for the longest period of time. So this is the same thing that I was telling you guys when it came to like the heat maps over here. This electronic tech sector over here. Usually like a few months ago, usually whenever this sector right here was green, even if all of this was red, the entire market was being held up by these companies, and it was really being held up by a few companies on here, like Nvidia for sure, multi-trillion-dollar uh valuation and everything. Apple was holding it up, you know, Intel, Microsoft, Google, things like that, right? But when they were talking about the bubble, with the AI bubble would pop, basically they were saying that there was too much money in this sector, and when things start slowing down in this sector, meaning scalability starts slowing down in this sector, the market was just going to crash because this oh dang, y'all can't even see it. Basically this sector, when this sector crashed, essentially what they were saying was when this sector crashed, it doesn't matter, it didn't matter what this was going on. All of the gains that we were making over the past year or so, most of it was finna look like this, what we're seeing right now. Because they were blaming most of these highs on just the AI. On just AI. All of this that I done charted, these were wins, by the way. But this was while AI was holding up the market. So yeah, essentially that's what he meant by, or what most investors were talking about. The market was going to crash at some point because the AI bubble was going to pop, right? But what he's also saying is AI spending likely won't slow down. Let me move this because I don't want to be taken down again. AI spending likely won't slow down. So where will all of that money go next? Right? Essentially what he's saying is AMD is betting that it'll shift to hyper optimized low cost chips that could easily be swapped out as models keep improving. Then he's saying this other company, Cerebrus, is betting on wafer size chips that cut out rack level network cables and switches altogether. So currently, if you don't know, Nvidia is operating off like wires and cords and like, you feel me, like analog shit. Kind of like you still like it still has to be plugged into certain interfaces and stuff like that. Um, but they're just doing it wafer size chips that can do it without all of that wiring and can like those connections and stuff. And Nvidia is betting that GPUs will turn into an asset class of their own because somebody will always want to rent them, right? So what AMD is doing with Thales, that company Thales, that they're etching, those processors directly into the GPUs. That could be something. I'm gonna keep my eye on those companies. But what's also drawing a connection to me, or some type of pattern, in my girl's words, pattern, Southern words. I don't know why they over pronounce certain syllables. I don't know. It's funny. But yeah, what I'm getting is Cerebrus being as though they can't keep up in terms of manufacturing those wafer sized GPUs that they're making. What they're now doing is they're renting them back from the companies that they're selling them to in order so they can keep up with production. So they're renting them. Nvidia is betting that GPUs will turn into an asset class of their own because somebody will always want to rent them. So essentially, from what I'm understanding, Cerebrus and Nvidia are kind of in the same. Like Cerebrus, they want to do better, but because they can't keep up with manufacturing, they're having to rent it, which is what Nvidia is saying is going to have to happen anyways. It's going to have to be an asset class of its own, right? Um, so essentially, like, I'm gonna do some more research into Cerebrus as a company and AMD, right? The reason why is because from what he was saying, right? AMD has some type AMD combined with Thales has some market edge in terms of brand new tech that could possibly change the way that these processors and GPUs are made in order to, process faster instead of you having to see line by line in the AI's, thought process. It all just gets there. Whereas in Cerebrus, they're making wafer sized um chips. They're making wafer sized chips, but they're also falling into what Nvidia says that the market is going to be anyways. So if they're making those wafer sized chips and they're supposedly better than what Nvidia's chips are, or better in ways, I'm not going to say completely better because I'm pretty sure that they're, because I saw something in the video here. Oh, let's see if I can find it. Let's see if I can find it. yeah, this right here. Where Cerebrus never cuts the silicone wafer into separate chips. Here is what that buys measured against a full NVIDIA chip. Let's see. Let me get that down. Subtitles off. So although their chip is bigger, it says 36 times a full NVIDIA rack. So 21 petabytes per second is 21 million gigabytes every second. A whole GB 200 NVL 72 rack, all 72 Blackwell GPUs together moves 0.58 petabytes per second. Which, from what he's saying, is essentially the entire catalog of movies and TV shows that are on Netflix. Just so you can understand what this means. All the TV shows and movies that are on Netflix, which honestly, in my personal opinion, aren't a lot. It seems like every time I sign on to Netflix, they don't got exactly what I want to watch. But, you know, but they can move the entire catalog over to another platform. I think like five times every like second or something like that, or millisecond or something crazy like that. The chip also carries 44 gigabytes of SRAM on the die itself, 88 times what sits on a Grok LPU. And the reason the cores never wait on cables, right? So they don't need cables like NVIDIA's chips do. But bigger doesn't always mean better, because NVIDIA, although it's smaller, NVIDIA packs 50% more in, it packs 50, it's not denser. Yeah, 50% more power, essentially. Because it's keeping up with these GPUs, these bigger wafer size GPUs, but it's still smaller. So 86 million transistors per minute, 130 million transistors per minute. And that's, comparing the Cerebrus chip, the wafer size chip, to NVIDIA's chip. So 29 times the area, only 19 times the transistors. So Blackwell is built on a newer TSMC 4nm class node. The WSE3 is a 5nm because you cannot economically print a whole wafer on the bleeding edge, whatever that means. I'm not even going to sit here and act like, because I was really going to sit here and talk about all of this stuff and act like I know exactly what I'm talking about. I don't know shit. I'm just saying, NVIDIA's keeping up. They're doing not as big as things. They're not computing the same amount in terms of the size of that big wafer size GPU, but they're keeping up with the smaller size. So bigger doesn't always mean better. It's about what you do with it. For my guys out there, but actually, cut that. That's kind of sus. I ain't worried about none of that, honestly. I don't got to. But yeah. If that's the case, I'm a really only check out, because NVIDIA's already did the numbers that it's done. I'm a, of course, invest smart. But it seems like my focus should be on whoever has the newest tech that could be revolutionary, which, and from what he's saying, is AMD and I was finna say Lupus, AMD and Talus. And Cerebrus, they have the bigger chips and they're wireless. I like the wireless concept because, we're moving into the future. I mean, if NVIDIA comes out with like a wireless, smaller processor, I'd be like, oh, all right, bet. But yeah, I'm gonna look into this shit. What are we watching next? see what other videos he has.
The key to finding great stocks before everyone else is understanding a company's products, not
I really just seen that my shit was muted. I just said all of this information. Let me see if it actually went through. I'm hoping that it did because my mic was on. I just had it muted over here. Please tell me it caught all of that because I'm not saying all of that again.
either way. I expect AI spending.
Keep up with manufacturing, they're having to rent it, which is what Nvidia is saying. Please, just so you can understand what this means. All type shit. All right, cool. Yeah, I wasn't gonna say all of that again. I was about to say y'all just gonna have to. Yeah, my mic was on, but I had. I don't. Well, then I don't know what this actually controls over here because y'all can still hear me even though I had that muted. Interesting.
Not just their profits. Huge growth happens when a company has the perfect product for a hot new market. Nvidia 10x'd in size because their chips dominate AI data centers. Palantir printed millionaires because their platforms bring AI to highly regulated industries. Well, there's another AI market that's quietly changing which stocks will win big, and almost no one else is covering it. My name is Alex, and I spent 8 years as an electrical engineer and AI researcher at MIT, and I've never seen a market opportunity this big. Let me show you what's going on and how I'm investing in it. Your time is valuable, so let's get right into it. I want to start this video in an interesting place. November 2022 in San Francisco. The key to OpenAI has just released ChatGPT, and it instantly spread like wildfire, hitting 100 million users in just 2 months. ChatGPT grew 4 times faster than TikTok, 15 times faster than Instagram, and 25 times faster than YouTube. The wave that followed turned out to be the biggest technology investment cycle since the internet. In under 4 years, Nvidia would grow from a $400 billion valuation to over $5 trillion because they designed the chips that power ChatGPT and every generative AI application that came after it. Investors who caught it early 4 times faster than TikTok, 15 times faster than Instagram, and November 2022 in San Francisco. OpenAI has just released ChatGPT, and it instantly spread like wildfire, hitting 100 million users in just 2 months. ChatGPT grew 4 times faster than TikTok, 15 times faster than Instagram, and 25 times faster than YouTube. The wave that followed turned out to be the biggest technology investment cycle since the internet. In under 4 years, Nvidia would grow from a $400 billion valuation to over $5 trillion because they designed the chips that power ChatGPT and every generative AI application that came after it. Investors who caught it early made life-changing returns, and they caught it early by understanding the science behind the stocks. But we're still in the very early innings. The global artificial intelligence market is expected to grow from roughly $750 billion this year to over $10 trillion by 2034. That's a compound annual growth rate of 38.5%, close to 4 times the returns of the S&P 500. But the global market for AI agents is expected to grow even faster, close to 44% per year, obviously from a much smaller base. And we can see that growth playing out in real time. Cybersecurity surveys show that the number of machine identities per human identity grew from 45 in 2024 to 82 in 2025 and is already over 100 in 2026. The average worker had 3 or 4 work machines in 2023, a laptop, a desktop, a server login, and maybe a separate work phone. That number exploded when software started needing logins of its own, service accounts, IP keys, and certificates. AI agents are the newest and fastest growing part of that, and 99% of organizations say they're already using them. But an AI agent isn't a normal piece of software. You don't tell it what to do. You give it an end goal, and it decides how to get there by building a step-by-step plan, reading files and data, calling tools and writing code, and even creating subagents to handle different steps along the way. And to do that, it needs credentials, usernames, passwords, API tokens, system permissions, and so on. But normal software security systems aren't built to handle that. For example, two factor authentication sends a code to your phone, but AI agents have no phone to go to. Normal permission systems are designed for human users, not software, so AI agents just inherit whatever permissions the software they're running on already has. And normal offboarding isn't meant for software either. Nobody files paperwork to retire an AI agent or verify that it lost its access after finishing its task. Over $1.7 trillion were spent on AI in 2025, but only $2.8 billion were spent securing it. Said another way, for every $630 spent on AI, only one is spent protecting it. That's the biggest gap I've found anywhere in the AI market, and big gaps mean big opportunities. Now let me tell you something that'll put you ahead of almost every Wall Street analyst covering AI agents. This gap is hyper-specific to identity management. According to CrowdStrike, 82% of threat detections last year were malware-free. There was no virus to find because hackers are logging in with valid credentials and using the company's own admin tools. Attack speeds are also exploding. The time it takes for an attacker to get in and reach a second system went from 48 minutes in 2024 to 29 minutes in 2025, 40% faster in a single year, with the fastest break-in time coming in at just 27 seconds. That's shorter than a red light. That's because attackers are using AI too. AI-enabled break-in attempts rose 89% year over year. That's attacks like injecting malicious prompts into companies' AI tools like Claude and Copilot to generate commands and steal credentials. Here's the big takeaway for investors. It's getting harder and harder to tell the difference between a legitimate user and an attacker. Detections triggered by legitimate AI agents are growing 150% faster than human-triggered ones. That means real attacks are hiding inside a flood of approved machine activity. That's why I'm not buying stocks that are focused on protecting against viruses or malware. I'm buying the ones that are focused on protecting identities. And like I said earlier, according to Market US, the global
That's smart. Buying stocks that are focused on protecting identities and malware for AI. Okay, that's super smart. I fuck with that.
protecting identities. And like I said earlier, that's why I'm not buying stocks that are focused on protecting against viruses or malware. I'm buying the ones that are focused on protecting identities. Gene activity. That's why I'm not buying stocks that are focused on protecting against viruses or malware. I'm buying the ones that are focused on protecting identities. And like I said earlier, according to Market US, the global artificial intelligence market is expected to almost 19x in size over the next 9 years, which is a compound annual growth rate of 38.5% through 2034. But many of the companies building next generation AI applications are not publicly traded. Think about the 90s and early 2000s. Companies like Amazon and Google went public very early in their growth cycle. But today, they're waiting an average of 10 years or longer to go public. That means investors like us can miss out on most of the returns from the next Amazon, the next Google, the next Nvidia. That's where VCX comes in, the sponsor of this video. VCX is the public ticker for private tech. Venture capital is usually only for the ultra wealthy, but VCX by Fundrise gives everyday investors access to some of the top private pre-IPO companies on Earth, and they have act only for VCX is the Nvidia. That's where VCX and the next Amazon. That means investors like us can miss out on most of the returns from the next Amazon, the next Google, the next Nvidia. That's where VCX comes in, the sponsor of this video. VCX is the public ticker for private tech. Venture capital is usually only for the ultra wealthy, but VCX by Fundrise gives everyday investors access to some of the top private pre-IPO companies on Earth, and they have an impressive track record, already investing over $500 million in some of the largest, most in-demand AI, infrastructure, and space launch companies. So if you want access to some of the best late-stage companies before they IPO, check out VCX by Fundrise with my link below today. Alright, so for every $630 spent on AI last year, only one was spent securing it. That's a massive market opportunity, especially in telling a legitimate AI agent apart from an attacker with stolen credentials. And there are 3 companies I think are perfectly positioned to tackle this opportunity. Let's start with Palo Alto Networks, ticker symbol PANW. If you've been watching this channel for a while, you know that I invest in technology platforms that other businesses pay to build on top of. While most of the cybersecurity landscape is fragmented into hundreds of different kinds of vendors, services, and solutions, Palo Alto Networks focuses on consolidating as many as possible into integrated platforms so that their customers can deal with one vendor, one management console, and one bill. In the enterprise world, that's a huge deal. Palo Alto has 3 main platforms that work together across the entire AI security stack: Strata, Prisma, and Cortex. Strata is their foundational layer for AI infrastructure deployment. It includes next-generation firewalls that use machine learning for packet inspection, application-based traffic routing, threat detection, and response. Companies are using it to see their network analytics, forecast outages, and even automate actions based on specific security policies. Strata becomes a key piece of the puzzle as more companies upgrade their networks to support AI workloads and agents. Prisma handles cybersecurity for cloud environments, services like container security, workload protection, and scanning AI models for vulnerabilities and blocking prompt injection attacks. And Palo Alto's Cortex platform focuses on SecOps, the teams that respond when something actually goes wrong, by providing tools for extended threat detection and response, automation, and advanced analytics to help cybersecurity teams do up to 4 times less manual work and respond to threats up to 50 times faster. Remember what I said earlier, attack speeds got 40% faster last year alone, and the fastest break-in took just 27 seconds, making Cortex another important piece of the AI security puzzle. But the biggest piece just got added last quarter when Palo Alto Networks closed its acquisition of CyberArk for $25 billion. CyberArk is a leader in identity security, not just for people, but for machines and AI agents, which is why I covered them as agentic AI was taking off last year. Well, back in May, Palo Alto Networks launched a fourth platform called Idira, a single place to manage identities, access, and permissions for every human, every machine, and every AI agent. Palo Alto Networks reported $3 billion in revenue last quarter, which was up 31% year over year. But annual recurring revenue from next generation security hit $8.1 billion, which is actually up 60% from last year, though $1.6 billion of that came from acquisitions, so their organic growth was closer to 28%. They report their full year earnings on September 1st, and this will be the first quarter with Idira on the market. So I'm excited to see their facts and figures around identity management. Either way, I think this integrated, end-to-end, four-platform approach puts Palo Alto Networks in a great position to grow as enterprises shift more money into securing their AI infrastructure, their AI software, and their AI agents. On the other end of the cybersecurity stack is Cloudflare, ticker symbol NET. Cloudflare runs one of the largest networks on the planet. When you load a web page protected by their services, your request hits their network before it ever touches the website itself. They absorb the attacks, block the bots, serve up cached content, and encrypt the traffic before letting it through. A huge share of the world's websites sit behind Cloudflare, which means they see network traffic patterns that no one else can see. That digital force field is their main product, and they sell access to it in three different ways. First, application services. They cache content close to the user so pages load faster. They absorb denial of service attacks, filter out malicious requests, and handle the bots. This is the layer that decides what traffic reaches a company's website in the first place. Second is Cloudflare One, their zero trust platform. Zero trust just means that the network doesn't trust anything by default. It checks every ID at every gate every time. That means Cloudflare's whole model runs on validating identities and permissions for people and for AI agents.
I like
And
that. Don't
third
trust
is their
shit.
developer platform called Workers. Companies can run their code on Cloudflare's network instead of in their own data centers, so that it executes close to whoever is actually calling it. Close to 2 million developers joined their platform last quarter alone, and a lot of that growth is coming from people building AI agents. Cloudflare hosts the agents, sees what web traffic they generate, and controls what they're allowed to reach. But here's where things get interesting. According to Cloudflare CEO Matthew Prince, bots have already passed humans in terms of total web traffic. About 57% of all page requests are now automated, with the other 43% coming from real people. And on their earnings call just a few days ago, Cloudflare said that daily requests from AI agents were up by more than 1,700% year over year. Cloudflare reported $696 million in revenue last quarter, which is up 36% year over year, and they raised their guidance to $2.87 billion for the year. Gross margins came in at 71.8%, which is actually down from 74.9%. I looked into why, and I found two main reasons, both of which are actually good. How can lower gross margins be good, you ask? Well,
Just so you guys can know, the only reason I'm not pausing it now is I figured let me check to see if he's gonna do that summary, that synopsis at the end of basically everything that he's saying in all these companies. Oh, oh. I don't know if y'all ever just seen y'all's faces just like damn, my shit uneven, gang. Ooh, ooh. Anyways, but I'm trying to see if he does the synopsis at the end. Once he does the synopsis at the end, if he does the synopsis on the end, then I'll be able to take notes and then basically just, move on.
let me show you. The first reason is that paid traffic grew relative to free traffic. Paid traffic is capacity that's consumed by Cloudflare's paying customers, and servicing it comes out of costs of revenue, since it's the cost of delivering a service that customers are paying for. That lowers their gross margins. Free traffic is capacity that's consumed by customers on free plans. Cloudflare books that under sales and marketing, since the free tier is how they get people onto their network in the first place, and sales and marketing is an operating expense, so it comes out after gross margins. So, as more customers shift from free plans to paid plans, Cloudflare's margins naturally drop. The second reason is the science behind this stock. Servicing AI agents simply is more expensive than servicing traditional websites. Worker execution, inference costs, controlling agents and AI web crawlers all consume new resources, which is why cost of revenues grew by 53% year over year, against their 36% revenue growth. Every company that's switching from serving people to serving people and AI agents is going to see their costs go up the same way. So Cloudflare is just the canary in the coal mine. Either way, I think that Cloudflare's position as the barrier between users and websites put them in a unique position to scale as more web traffic and more cyber threats come online from AI agents. And that brings me to SailPoint, ticker symbol SAIL, the smallest company
Okay.
on this.
So by canary in the coal mine, basically, or in the whatever mine he's saying, I've heard it before. I just can't think of it. But essentially, you don't need them. You won't need them until something is like happening. So like essentially, you carry them along with you or whatever like that. And when shit goes down, you let the canary free just to see if. Hold on, I need to pay attention to that. You see what I'm saying? Like they're just running in the background. So literally, the you shouldn't be looking at this company or valuing this company the same way that you do the others who are actively on top of everything. I fuck with it. I see it.
This list by far. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That really helps the channel and it lets me know to make more content like this. Thanks. Now let's talk about SailPoint. Identity management is a boring job that every company has to do. When somebody joins, they need access to email, file servers, timesheets, and whatever software they need to do their job. When they change rules, so does their access. And when they leave, all of it needs to get shut down. And once a year, somebody has to prove to a security auditor that everyone's access still makes sense. SailPoint sells the software to manage that entire lifecycle. Remember, one of the big problems with AI agents is that nobody files paperwork to retire them. Well, back in May, SailPoint extended their software to do just that, with a service called Agentic Fabric. It inventories every AI agent, machine identity, and application inside a company and then maps each one to a human owner. That's important because it turns out that only 37% of organizations can revoke an AI agent's credentials today, and you can't revoke something if nobody owns it. SailPoint even tells you what percentage of identities they manage aren't human. On their June earnings call, their CEO said that non-human identities were responsible for 40% of their growth that quarter, and now make up 14% of everything they manage on their cloud platform. Said another way, 1 in 7 accounts they manage are now machines, and so are 4 out of every 10 new ones. And that number will only keep growing as the ratio of AI agents to humans keeps going up. As of their latest earnings call, annual recurring revenue hit $1.16 billion, which was up 26% year over year, with the cloud portion of that growing by 36%. Revenues for the quarter came in at $280 million, and those were up 22%. And all of these numbers beat the top end of their guidance. SailPoint is one of the last standalone vendors of any size doing this job. On one hand, that means they have to compete with companies that can bundle that service with a lot of other things that customers already pay for, like Palo Alto Networks and their platforms. But on the other hand, it makes SailPoint a prime acquisition target. Palo Alto paid almost 20 times ARR for CyberArk when the deal was announced, and almost 15 times ARR by the time the deal closed. At those same multiples, SailPoint would get acquired for around $20 billion, which is almost double its current market cap. Just to be clear, nobody is making an offer to buy SailPoint at the time of this recording. I'm just pointing out the math. SailPoint reports earnings again in a few weeks, and I'm curious to see how many machine identities they'll end up managing. Another canary in the coal mine for what's coming as more businesses adopt agentic AI. And we're still in the very early innings. The global market for AI agents is expected to grow by almost 44% per year, with the number of machine identities per human growing from 45 in 2024 to over 100 in 2026. Breaches and cyber attacks are too costly to ignore, So every company on Earth will need a way to manage these machine identities. That's why I'm investing in these 3 stocks. And if you want to see what other stocks I'm investing in, check out this video next. Either way, thanks for watching, and until next time, this is ticker symbol U.
Okay, so
Okay, so I'm gonna take the time to actually, I guess write these down now because he didn't do the synopsis like he did at the end. I felt like I was just being, what's the word I'm looking for? Can't think of it
Close to
right now.
2 million developers join their platform. Third is their traffic network before it ever touches the website, their AI software, and their AI agents. On the other end of the cybersecurity,
Redundant. I felt like I was being redundant in the last video, being as though I just repeated exactly what he said. But and I hate those videos on social media. Anytime somebody watches the video and just repeats exactly what we all just heard this dude say. So I just didn't repeat anything. So I'm gonna write down notes on this, and then I'm gonna get back to you guys on what I got from it. Check.
security stack is Cloudflare, ticker symbol NET. Cloudflare runs one of the largest networks on the planet. When you load a web page protected by their services, your request hits their network before it ever touches the website itself. They absorb the attacks, block the bots, serve up cached content, and encrypt the
Okay, so here's what I got so far. All right. 3 stocks quietly making millions, right? Stocks focused on protecting AI from viruses and malware are one side of the coin, but from what I'm hearing, a smarter side of the coin to look at are the ones focused on protecting identities, right? Cloudflare, its ticker symbol is NET. They see network traffic patterns that no one else does, and sell access to it 3 different ways. So, meaning they sell access to the data that they get in order to protect against it to these companies in 3 different ways, right? Their application services. So they help pages load faster by caching content close to the user, essentially working as an ad blocker in every other way in the background, as I understand it, right? They also have their other product, Cloudflare One. This is their zero trust platform that checks every ID and every gate every time. So their whole model turns on validating identities and or runs on validating identities and permission. So it doesn't trust any AI agents or any person, like, consistently coming in. You gotta do checks every single time just to use a specific software. So, like, if somebody was using ChatGPT and some AI agents to run some type of business workflow of theirs, it's not like, it would be like somebody who was previously working for you can consistently go in there and every time, no, it checks the IDs and everything every single time, so nobody can just like continuously keep mooching off you type joint. So lastly, or even if you put an AI agent out of service as well, it'll also keep checking on that AI agent just to make sure it's not continuously getting up in your business type junk. So lastly, their third one. Their third one is a developer platform called Workers. Companies can run their code on Cloudflare's network instead of their own data center. So that is so that it executes close to wherever is actually is calling it. So that's their platform called Workers, right? And somewhere smart for you guys to look, just in case you want to look for companies of your own that do security. Look at companies serving people and AI agents. Both. Not just people, but also the AI agents that come with those companies and those people. SailPoint, ticker symbol SAIL, SAIL. Their identity management is, so basically their whole premise is identity management is boring and tedious. It's a boring and tedious job to do. So when someone joins a job, they need access to email, file servers, timesheets, and software to do their job. When they leave, all of this needs to be shut down. And access to these always needs to be monitored. What Sail does is it manages all of this, including managing AI agents. They currently compete with one other company, Palo Alto Networks. So do your research into those. Those are 3 different companies that, work in the security space for AI. I'm going to do more research on my own once I'm off stream, and then I'm going to come back to you guys with it in the breakdown and synopsis in the beginning of the stream. But as it is, that's it for today, at least for me. I'm about to go to the gym and work out. Yeah. It was great speaking with you guys. It was great hanging out with y'all. See y'all next time. We'll really see y'all tomorrow. Peace and love. Peace and love.